this week. I'm going to get the chat on and rolling here on the side. Okay, so for Monday, yesterday, we didn't have anything. All right, we actually had, was actually interesting because we did actually had the some FOMC speeches and the Chair Powell giving a speech on Monday. All right, so that was pretty interesting, very uncommon this to happen. All right, so that was pretty much it. We did have the China loan prime rate 5 years and the People Bank of China loan prime rate, but nothing much happening as everything was as expected. Okay. After that, we did have the Bank of England Monetary Policy Committee member Broadbent giving us a new speech. I didn't watch it. I don't think there is much to do with him. He's not a very decisive person into the Bank of England. Okay, and then we got some FOMC speeches, and that was pretty much Monday. So basically nothing happening on yesterday. Today we did had some things. All right, we had the RBA meeting minutes. We had the German PPI, so 0.2% as expected, as the consensus was 0.3%. So that means that the manufacturing may be coming lower. All right, and we're going to have the PMIs later this week. I'm going to touch base on that in a second. I think it's on Thursday or tomorrow or Thursday, not too sure. We're going to have a look on that. And basically the PPI, the producer price index, came lower on German. All right. Still today, we're going to have the CPI. All right. We're going to have the CPI for Canada, and we're going to have the ECB Lagarde giving us a speech in 50 minutes, 49 minutes, more precise. If someone wants to join us here, welcome. Bernard. Welcome, mate. All right. So we're going to still have some more FOMC speeches, and then going to Wednesday, we still have more and more FOMC and Fed and Bank of England speeches, and then we're going to have RBNZ interest rates decision, monetary policy statement, rate statement, and the press conference. As usual, all of those news come together in one package. So you know, it may be a little bit volatile for the New Zealand dollar. All right. What else? We're gonna have the CPI for UK and the ECB Lagarde giving a speech as well. On Thursday, we're gonna have all of the that's where I'm saying the German manufacturing PMI, the German services PMI. So that would be very interesting to watch as well. The UK, the Eurozone, the S&P Global CIPS UK Composite PMI, and the manufacturing PMI and the services PMI for UK. So all of those will come at 6:30, and the Euro area will come at 6, and the German will come at 5:30. And France will come at 5:15. After that, we're going to have S&P Global Services PMI and the manufacturing PMI. So very, very important day on Thursday for US dollar and the euro and the pound. Basically, the three major currencies on the market. Interesting to see that happening. And then on Friday, we have German GDP, core retail sales for UK, and this is it. We're not going to have anything else this week. So we're only going to have RBNZ rate statement and the rate decision and the rate minutes, the meeting minutes. We're going to have UK, France, German, and all of the Euro area, Eurozone manufacturing PMIs and services PMIs. We're going to have USA manufacturing and services PMI, and we're going to have the GDP, German GDP, and UK core retail sales and retail sales on Friday. All right, guys. So this is pretty much it for the economic calendar. Does anyone have a question regarding the economic calendar? I think it's pretty easy, isn't it? Okay. So let's go for what actually matters. All right. Let me open ACY website. I've just posted a well, it's not me, but I've wrote it. I've wrote it a market analysis that I've called it the endless struggle of central banks and the inflation. Now, inflation is grinding higher, and I've showed these to you guys last Thursday. Okay, I've showed to you all last Thursday that inflation is grinding higher and higher. And that only 1 month down, it doesn't count as, oh my God, inflation is now coming lower. No, because when we look to inflation coming lower, we can't look at only one data from the last month to this month. Okay, it come lower. No, it didn't. We need to look at the whole context, at least a quarter, so at least 3 months for data coming lower. If this is not happening, then inflation is not coming down. Inflation is actually fluctuating on the levels as it is. And for you that were here on last Thursday, I've read it with you that the ECB is expecting inflation to stay at the 2.2, 2.4 mark. So there's a lot to be done yet with inflation. Okay, but there's even more to be done with some of the items that it's very hard to find those inflations. And one of them are, and 6 of them are the rent inflation, the homeowner inflation, the car insurance, the car repair, the transportation, and the US produce price index for the cement and concrete product. So let's have a look on this inflation here and see how they are at this moment. So the rent inflation is up by 5.4%. If you were here on last Tuesday, you know that because I've mentioned it that. The homeowner inflation is at 5.8%. So rent inflation is different from the homeowner because the homeowner, he owns the property, so it's the landlord, and the rent inflation goes for the tenants. Okay, so the tenants have a different inflation of the homeowners. All right. Then we have the car insurance inflation that is up by 22.6%. It's out of mind, 22.6%. We have for the car repair inflation, 7.6%. Sorry. And we have the fifth, that's the transportation inflation, that it's 11.2%. And keep in mind that inflation has been above 3% for more than 3 years now. Okay. This is on the US, guys. I'm talking about the US here. So the US Producer Price Index, the PPI, for only 2 items, the cement and the concrete product manufacturing, it rose to 247.8 from last month of 247.5. So there were a rose of 0.3%, but this 0.3%, this make a big effect. So we can have a look on the image here. That since 2018, actually let's take here to 2022. That was when the COVID started, right? All the way to now. So we pretty much went from 210 all the way to 250. Let's call 250 to do easier math. So pretty much 40 points. 40 points, and there's no signs of this coming down. Okay, so what does this basically mean? Does anyone wants to get want to have a guess? No one? Okay. So basically this will accumulate to the prices of building the houses. All right. So if one thing we need to understand, not only the houses, okay, because this is the cement and the let me show you the cement and the concrete, okay. That's the producer price index for the cement and the concrete. So if those things, that's basically the base material for building goes higher, those buildings will have an effect because it will have to be costing more. Okay, so that's a pretty simple answer, right? So if we look to the inflation around the world, we have USA with a 3.5%, Euro area with 2.4%, Japan 2.7%, UK 3.2%, Canada 2.9%, Australia with 3.5%, New Zealand 4.0%, Switzerland 1.4%, and Denmark 0.8%. So if we would rank, would be 0.8 would be Denmark, Switzerland, and then we would have Euro area, right? So actually pretty impressive that Euro area is going that low with the inflation. After Euro area, we would have the Japan, and then after Canada, and so on. So inflation does come down in some countries, right? Because we had a peak of inflation. Some countries at 11%, and right now we're trading, let's say UK, for instance, at 3.2. UK, if we look at the chart here, UK CPI, 5 years. So if we look at October 2022, UK with 11.1% inflation. These that I'm showing to you is what a decrease in inflation looks like. Okay, it's looks like that 1, 2, 3 months are coming down, and then 1, 2, 3 months came down. 1, 2, 3 months came down. 1, 2, 3 came down. 1, 2, 3 a little bit higher, but 1, 2, 3 come down as well. So this is what the inflation coming lower means, not this. Okay, let me show it to you. USA CPI. United States Consumer Price CPI Index, that's the one. If we look to the 5 years and we look to this one, that's not what I want. Where is this? There you go, inflation rate. Is this one? Yeah, that's the one. So let's say 5 years. Look at this. This is not coming down. Okay, this is much more ups and downs than the UK. So if we look, of course, we did have a peak at nearly 8.2% or somewhere around that. But then we 1, 2, 3 came down, 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 and then we went 1, 2, 3 up, 1, 2, 3 pretty much the same, 1, 2, 3 again the same, and then here. So we're pretty much doing a curve like this. Okay, so we're not doing a curve as the UK is doing. All right, so this drags me a confusion. Why is everyone talking about the inflation is coming down at US when it's not? All right, so if we just put those two together here, it's so beautiful to see that UK came a peak of 11.1%, US have a peak on 9.1% June 2022. All right, so the USA hit the inflation peak first, then the UK, because UK hit the peak on October 2022, as of USA hit the peak on June 2022. So pretty much 4 months of difference. And with that, the Fed did have much more time to work on bringing down the interest rates, and the UK did not have 4 months. So what I'm trying to say is that the Fed is 4 months ahead of the UK. You get it? So basically, the Fed is advantage of 4 cars in front of the UK. All right. But still, inflation in UK came down much lower than it came down on US. Now, let's have a look on some other aspects here. All right. The debt. All right. The household debt. If we look at here, household. Oh, actually, it's on my blog. I don't need to search it up here. So if we look at the report, the household debt levels in the US have increased in the first quarter of this year, and it is creating challenges for already, people that are spending too much credit card. They are spending too much on the credit card. So basically, the overall debt levels rose by 184 billion, or that means 1.1% in the first quarter, to a total of 17.65 trillion dollars on debt for the consumers. So overall borrowing levels are 3.5 trillion higher than they were at the end of 2019, prior to the the COVID pandemic. All right. So these are not numbers that I'm waking up and thinking about it. This is actually from the Federal Reserve Bank of New York. All right, so it's here. Households debt rose by 184 billion in quarter 1, 2024. Delinquency transition rates increased across all types of debt. All right. Have a read. Have a read on this later on, because this is very, very interesting. To see that the mortgage debt, the home equity line of credit, the student debt, and so on. Now, moving ahead, let's talk about the interest rates here as well. Let's have a look at the CME. Let me bring it down. Just a second. Okie dokie. All right. I'm going to ask a question, and it's a simple question. I know everyone can do that. All right. Who thinks that the Fed will cut the rates? All right. I'm going to wait for you guys. At least a few answers. Come on. All right. 1. Okay. That's good. That's only the first question. All right. So 1. So Wilfredo thinks that the UK will cut. Is that right? Is that what you mean? Okay. ECB first. Okay. All right. So basically, okay, UK, go on. Go on. I'm liking it. And I like this. I like this. Okay. So pretty much so we have 1, 2, 3, 4 people. So UK 1, ECB 1, and no, sorry, UK 2, ECB 1, and the Fed. Is that correct? So Stuart is with the Fed. Wilfredo is with the UK. Aditya is with the UK, and Sam is with the Fed, with the ECB. So we have 1 ECB, 2 UK, and 1 Fed. Very interesting. I like that. I like that. Let's have a look at the CME Fed Watch 2 here, and later we have a look at the UK, and later, okay, one more, Stephanie, thanks for sending your answer, mate. UK, wow, everyone thinks that UK would do first. UK again, sweetie, wow. So pretty much 1, 2, 3, 4 people with UK first. I'm really want to understand why you guys think the UK will cut first. That's my really want to know why. Really want to know. But anyways, so let's go. ECB UK first. Wow, everyone is on UK. Okay. Okay, I like Tao answer. No one of them. I like, okay, so, all right, too much answers now. This is it. Thank you so much. Okay, so let's have a look at the Fed Watch 2 here on the for the 12th of June. Okay, for 12th of June, we have 96.4% of the people, of the market participants expecting no cuts. All right, so remembering that the current rate is 525 to 550, it needs to work on a band. All right, so it's fluctuated, it's not been set. So 525 to 550. Then we go for 31st of July. 76.4% of the market is still not expecting anything from the Fed. 18th of September, 49.6% of the market is expecting 25 base points cut. Okay, so now let's have a look. 38.2%. Let's do a little bit of crazy thinking here. I like to do those things. So 38% of the market expects no cut. Okay. 49.6% of the market expects cut 25. All right. 11.8% of the market expects a 50% cut, a 50 base points cut 50. And 0.4% of the market is expecting a cut of 75 basis points. This is just ridiculous, crazy. Okay, so we have these people here definitely won't happen. All right, this is just something that it's out of probability, and the Fed already say that. All right, it's just don't even think about it. So 0.4%. This 0.4% will probably drop to here. Okay, so then we're going to have 12.1%. Okay, so we're going to have 12.1% here. So let me put here 12.1%. Then this will get eliminated. Okay, and this probably won't happen as well because 50 is too much. What's the closest to that? This 12% will come to the 49.6. So that's going to be 62%. If I'm not wrong, 62%. And this will stay on here. So the probability yet is still of a 25 base points cut on the 18th of September. Now, why did the market priced in like that? Because remember last month I was talking to you, to everyone, and I've mentioned that the Fed was looking to cut, but on November. So pretty much the cut came out from November to September. Okay, so if we look now in November, no one is expecting a cut because, well, we're going to come from 525 to 525 to 550 to 5 to 525. Then we're going to go to the 7th of November. We're going to be 45% of the people expecting no cuts from the new target range. Can you guys understand that? Pretty simple, right? All good. Okay. So, and only 25% of the market still believing that this won't cut. So then we go to 18th of December and we're expecting this here, okay? This here is a bit tricky. So because if we cut on the 18th of September, this won't be existing anymore because this is the old policy. So this will jump to here, okay, of no change. And these guys will probably stay the same because they continue to believe on a cut. But this one will increase from 34 to 35.36. So you still got a 0.2% of difference in there. What a crazy thing, isn't it? So in my personal opinion, the Fed won't cut. The Fed won't cut. All right, the Fed won't cut for some simple reasons. And one of them being inflation will come higher. And the only reason inflation came lower this last month is because they manipulated the data. Kinda simple as that. Okay. Now, I've prepared a video for us to watch. That is right here in the YouTube. Is it this one? Yeah. So let's watch this video here. I'm gonna share my audio with everyone as well. So share my screen, share sound, share. Okay, you guys can probably hear it now.
Workspace.
We know that the Fed, certainly Jay Powell likes the University of Michigan numbers, and if you look at expectations and assessment of current conditions, they're both dropping a little bit, Trevor. So what do you do with that number?
It's very mixed data, both on the inflation side, where you would expect inflation to start to kind of ease, and it might be sticky on the way down, but you would expect inflation to drop. I see more scope for that at the moment in Europe than in the US. On the other hand, the growth picture is a bit mixed as well. You've got some contradictory signals from things like consumer confidence and the bit of the cycle that looked like it was accelerating 2 or 3 months ago, which was production. The more recent data from the purchasing manager surveys suggests that maybe that's actually petering out as well. So it's a really tricky one right now. And I think what it says is central banks are on hold. And when things become clearer, they'll be hiking or they'll be cutting. But hikes are definitely possible if the economies just stabilize from here and production picks up. I think rate hikes are possible.
Wow. Okay, so we come to Bloomberg now, and there's a guy saying that the hikes are possible when we know that it's not possible. So see that the media is trying to say something, but they are trying to confuse everyone when the numbers in front of us just say that, look, if they hike the rates, the economy will do kaboom. And I don't agree much with this idea of if the inflation, if the economy gets stronger and stronger, they would have to hike the rate anymore. Hikes the rate, there's a probability of another hiking on the rate. I don't think this would be actually something that could be possibly happening, because it's just out of the market expectations at the moment. And if it does surprise too much, then that would be too crazy. Okay, then I have another video here I want to show you guys. Just need to find out where is this. Okay, we come back. Business time, Bloomberg videos. Oh, there you go. Here. Okay, let's go.
We've been talking about inflation on Wall Street Week for some time now. I know you're not hoping for more inflation, but you've been warning about it. What do you make of the numbers we saw today? We've been talking about inflation on Wall Street Week for some time now. I know you're not hoping for more inflation, but you've been warning about it. What do you make of the numbers we saw today?
Oh, thanks, Sam. I didn't know that. So this guy here is one of the formers of the Fed. Okay, so he pretty much have mentioned 1 month ago. Here we can see 1 month ago. That's in Portuguese, but it's 1 month. Translate to English so everyone can see it. 1 month ago, he've mentioned that there is a possibility of inflation continue to come higher, so the CPI can continue to come higher, and this little this little downtick here that we just had is not sufficient to prove the fact that there is a possibility to cut the rates, just because after 6 months of continuous high intensity on the CPI, it doesn't matter. Okay, so let's continue to have a look on that.
I was not hugely surprised by the numbers. In an economy that's growing faster than potential, with an unemployment rate that has a 3 handle, in the presence of massive and growing budget deficits and epically easy financial conditions, the idea that inflation would remain robust or even accelerate should not be a surprise to anyone. And that's what this data suggests. It was not me or some outside observer who emphasized the concept of supercore inflation, that is taking out the transitory stuff and also taking out housing. And by that measure, inflation is running at above a 6% rate, and the 3-month rate exceeds the 6-month rate, and the 6-month rate exceeds the 1-year rate. This confirms the idea that the neutral rate is way above the 2.6% level that the Fed has been using as a North Star. In my view, puts back on the table. It is still not what I would expect, but you have to take seriously the possibility that the next rate move will be upwards rather than downwards. And anything could happen. Markets could crash, the indicators could turn down, but on current facts, a rate cut in June, it seems to me, would be a dangerous and egregious error comparable to the errors the Fed was making in the summer of 2021 when it just didn't get the thread on inflation.
Okay, so we come to an end here of the video, and I ask you the question now: do you actually think that the central banks will cut the rates this year? Do you really think that they will do that? You sure? No way, exactly. So hopefully I could open up the mind for you guys and see the picture, that is happening. All right, see, it's everything in front of our eyes, and this is why it's so important for you to come here at the website, look to the posts I'm doing every day. Right, sometimes I'm not too active on the Telegram because I'm busy collecting those types of information. So be ready. We're just in the half of the year. We're coming now to the half. We are very close to the end of the month with 21st of the May. So we're going to the June very, very soon. Going in 10 days. 1, 2, 3, 4, 5. Yeah, 10 days, 11 days. So be ready, guys. As long as they pay us 5% of our savings, we're good. It's a trap to make consumers spend more by then. It's a trap to make consumers spend more by telling them they will cut rates. Yes, but that's the problem then, Sam. If the consumer spends more, then it generates more inflation. And I'm not too keen to say that, but then they would have to hike the rates again. But I'm not too keen to say that again. I'm not willing to say that because I don't think this can happen. I think it's too virtuous from the situation right now. It's out of mind. A person coming in and hiking 25 base points again. Just not how it works. Okay. All right. What else did I mention? I get it. Naturally, humans will say, great, lower rates, more example cash. Correct. Correct. You are correct. Now, I have some other stuff I want to talk about before we go to the charts. Let me just check it here. I've talked about the debt. Okay. All right. So the Australian government inflation. The Australian government holds hope that inflation will cool quickly, expecting it to return to the Reserve Bank of Australian target band of 2 to 3% by the end of this year, which is ahead of the RBA's forecast. So the inflation is already ahead of what they are expecting. So what they were expecting to be. So that's good. But the RBA seems to me that nah, they won't give a cut. Then the lower productivity in the Eurozone is a problem for the European Central Bank as it waits on the interest rate cut on next month, okay? Because there are some priced in, okay? Let me see ECB overnight rates. The ECB interest rates, I don't think I have it. Yeah, we don't have it. Yeah, we don't have it, unfortunately. And the Fed says that stagflation characterized by stagnant economic growth alongside with high inflation and high unemployment poses a unique challenge for central banks like the Federal Reserve. The difficulty in taming in stagflation stems from the fact that traditional monetary policy tools often work at cross purposes when addressing both inflation and unemployment. We had the 70s stagflation, we have the early 2000s, and Chair Powell have made a comment that the Fed must be patient and wait for evidence that inflation is still moderating. It looks like, he says, he quoted, it looks like it will take longer for us to become confident that inflation is coming down to 2% over time. You guys don't want anything else? Anything else more than that? So just so you know, it is what it is, okay? Now, let's go to the charts and see where the opportunity is hiding, all right? Where the opportunity is at this momento. Who thinks what is a good opportunity at the market for this moment? I have in front of my screen right now. Having all of these in hand, let's come to the daily chart here of gold. And we can see that from 2024 26 January to now, gold has risen 20% already without leverage. All right, so just having gold on your portfolio, you would have a 20% up move. And lots of things about that. You know, we have the Basel III Act, we have the geopolitical effects that impact that we had. So we have lots and lots of opportunities in there. But I do believe that gold can reach 3,000 to 3,500. Well, more to be honest, in 200, 3,000 to 3,200 in the end of this year, Q4. Okay, so 3,000 to 3,400. Well, sorry, 2,200. Right, in the end of this year. So I'm looking for another 20, 30, let's say 30, between 20 to 30% up move on gold. So that is my option for this scenario at the moment. I want to protect it. I want to be safest as possible. I will be going for gold. Okay. My conclusion is that inflation is remaining very persistent. And this is challenging the central banks, okay, including the Fed, including the Federal Reserve, that they don't know what to do with the policy, right? They don't know how to respond with the tools that they claim they have, so many tools that will normalize inflation and so on. So there are, you know, lots and lots of efforts to bring inflation down. But despite these, which has surprised the targets for over 3 years already, the Fed approach remains uncertain. And they say that we are data dependent. We need to see that inflation coming down more, okay, more close to the 2%, because remember, we are at 3.2 now. So we still have 3.4, we still have 1.4% to come lower. And I've mentioned that multiple times that this is the hardest part. Bringing inflation down from 11% to 3 is easy because that's inflated. But then now bringing to 3.4 to 2.1, it's very hard. Okay. And of course, this is have lots and lots of impact as well. Rising the prices in essential sectors is straining household budgets, exacerbating financial vulnerabilities, and without clear strategies from the central banks, inflation is most likely to continue to go higher, and this is most likely to get poisoned by all the economic and have more risks toward the countries. So 2023 was just a little preview of what we're going to have in 2024, 2025. So don't listen to them. All right. Don't listen to them. Go there, do your own research and see that the numbers don't match. All right. The numbers don't match. In the end, it's just politicians trying to tell what they think that will happen, but they don't know anything. All right. Who am I? I don't know anything as well. I'm just looking at the data and showing to you all. So now you may ask to me, oh, well, where is the best entry point? Look, I don't have a best entry point. I'm just going to start longing it. I'm going to long here, and the market comes to a pullback long here. Another pullback long here, comes to another pullback and long here. Then look, I'm just starting to long. Okay, so this is not a personal advice. I'm not telling you to do this. Just make sure that you understand that this is just my own opinion on the market here. Okay, guys. Now, in terms of the Forex market, euro dollar will probably come down to the 105. Okay, after this pullback here, we still have sort of a downtrend here. Okay, so this is the up move there. And most probably we could go for the 4 hours. We can probably see that, and it's very easy to understand. Look at how big was this move. Was pretty much 1, 2, 3, 4, 5 candles that moved all of these down. And look at how many candles you need to have to do this move up again. Okay, so the market is still pretty much selling it euro dollar, and I think this is a good point to start to short it again. Okay, because this target have been heated already. This one have been heated already. This one have been heated now. Most probably we are coming to this one first, and then we're gonna come to 0.5. Okay, so yeah, 0.5 somewhere here actually. Yeah, so this is my take on euro dollar. Okay, now going to the Aussie dollar. I've got my target hit at the 0.67. Yay. So most probably we are coming down again to this area first. Okay. And then we see how we're going to do on here. So, but first it's a small trade, but still is a trade. Okay. And then USD JPY, it's continue to be a good opportunity to long. Okay. For above the 160, we're going to probably go to 170. What else I was looking at? New Zealand dollar. New Zealand dollar still have a bit room to do to come around these levels. Okay, so probably we're going to reach this one first, and then we continue when we and then we're going to start to go down, being this one the first level. CAD JPY, I'm not too keen to trade these. New Zealand dollar, USD CAD, the same. Okay, I'm not too keen to trade these for the coming months. USD CHF, not too keen as well to trade it. But you know, we got our first target here, hit it, and since then it didn't move anywhere. All right. Because this was the main target from the banks. So look, USD there are opportunities to come this level, but I'm not too sure. Euro Aussie continuation to downtrend. Where was my target? I didn't have a target, but it's here. So basically, I expecting Euro Aussie to come lower. And what else? GBP USD. There we go. GBP USD, there is lots and lots of room for this to come at these levels, okay? Especially this year right now. If the boy cuts the first that everyone is expecting it to, but whatever, then it would be a good opportunity to continue to short GBP USD. Look, it doesn't have much things where to stop, okay? We'll probably do moves like this until somewhere around this area. What else? NZD, USD CAD, silver, gold. Yeah, CHF JPY, yeah, not too keen. Yeah, guys, this is pretty much my trades. Pretty much my trades for the coming months. Let's see how this will play out during the week, as well as we're gonna meet it up again on Thursday. So that's pretty much it. Does anyone have any questions? No questions? All right then. Thanks so much for coming. This will be look, in my option, I wouldn't trade USD CHF because CHF is just too tricky at the moment. So I wouldn't be looking to trade that pair. But if I would take a position, I would take long, but this is my personal take, right? It has to see how your strategy will work. UK CPI most probably coming lower. All right, guys. Thank you so much. And this, yes, will be uploaded on the YouTube tomorrow, so you can have a look when you wish. Subscribe to the channel, give us a thumbs up on the video, and I see you on Thursday. See you guys. Bye-bye.